Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Denominations. Denominations refer to the specific face values or amounts at which individual units of a financial instrument, such as bonds or currency, are issued or traded. In the context of bonds, denominations represent the nominal or par value of each bond, which is the amount that the issuer of the bond promises to repay to the bondholder at the bond's maturity date. Bonds are typically issued in various denominations to cater to different types of investors and their investment preferences. These denominations can vary widely, ranging from a few $100s to thousands or more. Depletion. Depletion is the process of accounting for the reduction in the value of natural resources or assets that are being extracted, used, or consumed over time. It is particularly relevant for industries like mining, oil and gas, and forestry, where companies gradually deplete their reserves as they extract and sell the resources. Depletion is similar to depreciation, but it applies to natural resources rather than tangible assets like machinery or buildings. This accounting method allows companies to allocate the cost of acquiring the resources over the period of their extraction, ultimately reflecting their decreasing value as they are used up. Depreciation. Depreciation is a method used in accounting to systematically allocate the cost of a tangible asset over its estimated useful life. This allocation accounts for the wear and tear, deterioration, or obsolescence of the asset as it is used in the business operations. Depreciation is recorded as an expense on the company's financial statements, such as the income statement, to reflect the reduction in the asset's value over time. Despite being recorded as an expense, depreciation does not involve an actual cash outlay. Rather, it is a non-cash expense that aims to match the cost of the asset with the revenue it generates during its useful life. Derivative. A derivative is a financial contract or instrument whose value is derived from an underlying asset, index, or reference rate. Derivatives enable investors to speculate on or hedge against future price movements of the underlying asset without owning the asset itself. They come in various forms, including options, futures, swaps, and forward contracts. For instance, a call option on a specific stock allows the holder to buy the stock at a predetermined price within a certain time frame, providing the potential for profit if the stock's price rises. Derivatives can be used for risk management, speculation, and investment purposes across a range of financial markets and industries. Designated broker. A designated broker is a financial intermediary that has a contractual agreement with an exchange-traded fund, ETF, issuer to facilitate the creation and redemption of ETF units. This process helps keep the ETF's market price in line with its net asset value. When demand for ETF units increases, the designated broker can create new units of the ETF by assembling a portfolio of underlying assets and exchanging them with the ETF issuer for newly created units. Conversely, when demand for ETF units decreases, the designated broker can redeem units by returning them to the issuer in exchange for the underlying assets. This mechanism helps ensure that the ETF's market price closely tracks its underlying assets' value and promotes efficient trading in the ETF market. Direct bonds. Direct bonds refer to bonds that are issued by a government as its own obligations, without any intermediary or third party involved. These bonds are backed by the full faith and credit of the government issuing them. They are considered the primary obligations of the government and are typically considered very safe investments due to the government's ability to levy taxes and raise funds to meet its debt obligations. Direct bonds are also known as unconditional bonds because they don't rely on any other entity's guarantee to ensure payment. This distinguishes them from guaranteed bonds, which are backed by another entity's promise to repay the debt if the issuer defaults. Direct Electronic Access, DEA. Direct electronic access, DEA, refers to the practice where institutional clients directly access electronic trading platforms offered by exchanges through their investment dealers. This allows clients to submit orders and execute trades themselves in real time, without the need for intermediaries to place orders on their behalf. With DEA, institutional investors can interact directly with the exchange's trading system, gaining more control and speed over their trading activities. This method can enhance efficiency, reduce latency, and streamline the execution process for large volume trades. It's important to note that DEA requires proper regulatory approvals and risk management measures to ensure responsible trading practices. Directional strategies. Directional strategies in hedge funds involve making investment decisions based on the anticipated movements of market prices for various types of assets such as equities, fixed income securities, foreign currencies, and commodities. These strategies aim to profit from the directional movement of these assets, whether it's an increase, long position, or decrease, short position, in their prices. Hedge funds employing directional strategies use various techniques, including fundamental analysis, technical analysis, and market trends, to identify potential market movements and make investment decisions accordingly. These strategies can encompass a range of risk levels and investment horizons, depending on the fund's objectives and the market conditions being analyzed. Director. A director is an individual who is elected by the voting common shareholders of a company during its annual meeting. Directors have the responsibility to oversee and guide the company's policies, operations, and strategic decisions. They play a crucial role in setting the company's direction, making important decisions, and representing the interests of shareholders. Directors typically serve on the company's board of directors, a governing body that is responsible for ensuring the company's long-term success, financial stability, and compliance with relevant laws and regulations. Directors may also be involved in key decisions such as appointing executives, setting executive compensation, and providing guidance on corporate governance practices. Director's Circular. A director's circular is a communication sent to shareholders by the directors of a company that is the target of a takeover bid. In this circular, the directors provide their recommendation to shareholders on whether to accept or reject the takeover bid, along with the reasons for their recommendation. This communication is an important part of the takeover process as it gives shareholders valuable information and insights into the board's perspective on the bid. It allows shareholders to make informed decisions about whether to tender their shares in response to the bid. The director's circular plays a role in ensuring transparency and fairness in takeover transactions by providing shareholders with the information they need to assess the offer and its implications for the company's future. Disclosure. Disclosure is a fundamental principle of securities regulation in Canada. It involves the comprehensive and transparent presentation of all material facts that are essential for making informed investment decisions. The principle of disclosure requires that companies and other entities provide accurate, complete, and easily understandable information to investors. This includes information about the company's financial condition, operations, risks, and any other relevant factors that might influence an investor's decision to buy or sell securities. The aim of disclosure is to ensure that investors have the necessary information to assess the potential risks and rewards of their investment choices, promoting fairness and transparency in the financial markets. Discount. Discount refers to the difference between the current market price and the par value of a financial instrument such as preferred stock or bonds. When a preferred stock or bond is trading at a price lower than its par value, it is said to be trading at a discount. This discount represents the reduced price that investors are willing to pay for the security, often due to factors such as changes in interest rates, market conditions, perceived risk, or the time remaining until maturity. The discount is calculated as the difference between the par value and the market price, expressed as a percentage of the par value. Discount brokers. Discount brokers, also known as self-directed brokers, are brokerage firms that provide buying and selling services for securities to clients at a lower commission or fee compared to full-service brokerage firms. These brokers offer a streamlined and cost-effective way for investors to execute trades in the financial markets. Unlike full-service brokers, discount brokers typically do not provide personalized investment advice, financial planning, or research services. Instead, they focus on executing trades efficiently and providing online trading platforms that allow investors to manage their investment portfolios. Discount rate. The discount rate, in the context of valuing bonds, refers to the interest rate that is used to calculate the present value of future cash flows associated with the bond. It represents the rate of return required by an investor to invest in the bond, taking into account factors such as the bond's coupon payments, maturity, and current market conditions. The discount rate is a crucial component in determining the fair value of a bond and helps investors compare the bond's potential returns with other investment opportunities. Discouraged workers. Discouraged workers are individuals who are willing and able to work, but due to prolonged unsuccessful job search or discouraging economic conditions, they have stopped actively looking for employment. These individuals are no longer counted as part of the labor force in official unemployment statistics, as they are not actively seeking employment. Discouraged workers can be an indicator of underlying issues in the job market, as they reflect a lack of opportunities and can contribute to hidden unemployment. Discretionary account. A discretionary account is a type of securities account where the account holder grants the authority to a qualified portfolio manager, partner, or director to make investment decisions and execute trades on their behalf without obtaining prior approval for each trade. This authorization is typically granted through a written agreement. The portfolio manager is responsible for managing the account's investments according to the client's objectives and risk tolerance. Discretionary accounts are often used by clients who prefer to delegate decisions to professionals. Disinflation. Disinflation refers to a period in which the overall rate of inflation decreases, resulting in a slower rate of price increases. While prices continue to rise during disinflation, the rate of increase is lower than in previous periods. This is distinct from deflation, where prices actually decrease. Disinflation often occurs as a result of various economic factors and may have implications for monetary policy and consumer spending behavior. Distressed securities strategy. A distressed securities strategy is an investment approach that involves purchasing the equity or debt securities of companies facing financial distress, potential bankruptcy, or restructuring. These securities are often priced at significant discounts due to the issuer's weakened creditworthiness or uncertain future prospects. Investors following this strategy aim to capitalize on potential gains if the distressed company successfully recovers and improves its financial situation. This involves higher risk due to uncertain outcomes associated with distressed companies. Dividend. A dividend is a payment made by a company to its shareholders, usually in the form of cash or additional shares of stock. Dividends are typically distributed from a company's earnings and are a way for shareholders to receive a portion of the company's profits. Preferred dividends are fixed and paid to preferred shareholders before any dividends are paid to common shareholders. Common dividends, on the other hand, may vary based on the company's performance and the decisions of its board of directors. Dividend discount model. The dividend discount model, DDM, is a valuation method used in finance to estimate the intrinsic value of a stock by considering the present value of its future dividend payments. The underlying principle of the DDM is that the value of a stock is essentially the present value of the future cash flows it generates, which, in the case of dividend-paying stocks, are the dividends paid out to shareholders. There are several variations of the dividend discount model, but two common ones are the Gordon growth model, also known as the Gordon-Shapiro model, and the two-stage dividend growth model. Dividend fund. A dividend fund is a type of investment fund that focuses on stocks paying dividends. These funds include preferred and reliable common shares from companies with a history of consistent dividend payments, aiming to provide a steady income stream for investors. Dividend funds offer a balance between potential income and market risks, with a higher dividend yield than regular funds due to their focus on dividend-paying stocks. Dividend payout ratio. The dividend payout ratio measures the portion of a company's earnings paid out as dividends to shareholders. It's calculated by dividing total dividends by total earnings. A higher ratio indicates more earnings are distributed as dividends, while a lower ratio suggests more earnings are retained by the company. Dividend record date. The dividend record date is the specific date on which a company identifies and establishes the list of shareholders who qualify to receive the announced dividend payment. Investors who own shares on or before this date are eligible to receive the upcoming dividend distribution. This date is crucial for determining who will receive the dividend and helps the company ensure that only rightful shareholders are included in the payout. Dividend Reinvestment Plan. A dividend reinvestment plan is a program offered by some companies that allows shareholders to automatically reinvest their received dividends to purchase additional shares of the company's stock. Instead of receiving cash dividends, participants in a DRIP receive additional shares, which can lead to the compounding of their investment over time. This process occurs without the need for shareholders to take any manual action, helping to increase their ownership in the company over the long term. Dividend tax credit. The dividend tax credit is a mechanism in Canada designed to incentivize investment in the shares of taxable, dividend-paying Canadian corporations. Under this system, taxpayers are required to declare dividends as income and then apply a credit against their federal and provincial taxes based on the grossed-up dividend amount. The federal government may modify the gross-up rate and tax credit annually, influencing the effective tax treatment of dividend income for investors. Dividend yield. Dividend yield is a financial ratio that indicates the annual dividend payments of a stock as a percentage of its current market price. It provides insight into the investor's potential return on investment in terms of dividends. A higher dividend yield suggests a higher income relative to the stock's price, making it an important metric for those seeking income from their investments. Dollar cost averaging. Dollar cost averaging is an investment strategy where a fixed amount of money is consistently invested in a particular security at regular intervals over time. This approach helps to reduce the average cost per unit of the investment, as more units are purchased when prices are low and fewer units when prices are high. This strategy aims to mitigate the impact of market volatility and potential timing errors, making it a method to build a diversified portfolio gradually. Domestic bonds. Domestic bonds are bonds that are issued by a company or government in the same currency and country where the issuer is located. For instance, a Canadian company issuing bonds denominated in Canadian dollars within the Canadian market would be issuing domestic bonds. These bonds are subject to the regulations and economic conditions of the issuing country and currency, making them distinct from foreign bonds issued in a different country and currency. Dow Jones Industrial Average. The Dow Jones Industrial Average is a stock market index that represents the average performance of 30 major and blue-chip companies listed on the NYSE and the Nasdaq. The index is price-weighted, meaning that the relative influence of each company is determined by stock price rather than market capitalization. The Dow Jones Industrial Average serves as an indicator of the overall direction and sentiment of the stock market, reflecting the performance of a select group of well-established companies across various industries. Drawdown. A drawdown, in financial terms, has two main meanings. First, it refers to a cash management operation conducted by the Bank of Canada to affect interest rates. This involves withdrawing deposits from direct clearers, reducing cash balances. Second, drawdown also describes the decline in an investment's value from its peak to its lowest point over a specific period, expressed as a percentage. This measure indicates the maximum loss an investor would have experienced if they bought the investment at its peak and sold it at its lowest point. Due diligence report. A due diligence report is a comprehensive assessment conducted by a dealer or investor when negotiating a new issue of securities with a corporate issuer. This report thoroughly examines the financial structure, aiming to provide an informed understanding of the issuer's financial health and potential risks. It plays a critical role in the decision-making process for both parties involved in securities issuance, ensuring transparency and informed investment choices. Duration. Duration is a metric used to gauge the sensitivity of a bond's price or the value of a bond portfolio to changes in interest rates. It represents the estimated percentage change in the bond's price for a 1% change in interest rates. Bonds with higher durations are more susceptible to price volatility due to interest rate fluctuations, making them riskier in terms of potential price changes. Duration is a key factor considered by investors when assessing the risk associated with their bond investments. Duty of care. Duty of care refers to the legal and ethical obligation to exercise caution and conduct thorough research before offering advice or suggesting products or services to clients. It requires individuals or professionals to act in the best interests of the people they are serving, ensuring that their recommendations are well informed and appropriate for the specific needs and circumstances of those they are advising. This duty aims to protect individuals from potential harm or negative outcomes that could arise from negligent or uninformed advice. Dynamic asset allocation. Dynamic asset allocation is a strategy that involves regularly adjusting the composition of a portfolio's holdings in response to changing market conditions or investment goals. This approach aims to maintain a portfolio's asset mix across different asset classes, such as stocks, bonds, and cash, despite market fluctuations. By periodically rebalancing the portfolio's allocations, investors strive to manage risk and capitalize on potential opportunities while staying aligned with their intended investment strategy. As we wrap up this session, we're thrilled to have embarked on this journey together, exploring the foundational terminologies crucial for acing your financial certification exams, including investment funds and Canadian securities. If you found our insights valuable, remember to show your support with a thumbs up and extend the knowledge to your fellow learners. We trust that these insights will prove indispensable on your road to success. Stay tuned for more enriching content, and remember, your financial expertise is just a click away.